good afternoon from the offices here at Heritage Wealth Management on this cool afternoon here in Houston, Texas. It's been a strange week with snow in central Texas. Got pictures from my daughter in the Austin area, and they had several inches of snow. So here we are, it's January, and we're in a new year. And I thought I'd take just a few minutes today to talk a little bit about 2020, talk about where we are now, and then just what we see into 2021. And not that my crystal ball is any clearer than anyone else's, but just spend some time talking about where we are and what might be reasons for optimism as we go forward. So, looking back on 2020, boy, what a year. In February of 20, we had record unemployment, we had an economy that was rolling along, and we had a stock market that was at all-time highs. In the midst of all of this, though, we had a pandemic that was spreading through Asia and into Europe, and it finally came into the United States in March of this year. And that was the point when elected officials decided that we had to shut the economy down for health reasons. And what we had happen was immediately the US economy, as well as the global economy, went into recession. We also saw the fastest drop in US equity markets in history, which the speed of it was a record, but not the amount of the drop. One of the things that has come up is just how unprecedented this was. The virus was unprecedented, our reaction to the virus was unprecedented, but a 34% drop in equity markets is not. That was the sixth time that it happened since World War II. So we have to keep those things separate. The other thing that was not unprecedented was investors' reaction to it. This massive sell-off that actually continued throughout the remainder of the year, even as markets recovered. The other thing that was so amazing is we really didn't shut the economy down until middle March, maybe March 13th, 14th, sort of that weekend. And on March 23rd, Jerome Powell and the Federal Reserve came out and announced new plans for more quantitative easing, which is basically the federal government buying government bonds, buying mortgages, things of that nature to create liquidity in the marketplace. They also created these different loan facilities, even for other nations, to create liquidity in the financial system. So this didn't go from a health crisis to a financial crisis. And they succeeded. And March 23rd is actually the day that the equity market bottomed. Basically 10 days after we shut the economy down, the stock market's bottoming in the midst of about as bad as things could get. If you remember back to that time, that was the first 15 days that we were going to be shut down for. We still had the entire month of April to be shut down. And yet at that time, equity markets were beginning to recover. And again, that's one of those reasons why we cannot time what the market's going to do, because oftentimes it begins to drop at the best times and it begins to recover at the worst times. Again, one of the reasons, and I'll kind of come back around to that here in just a minute. The other thing that was very positive was Congress came together, the Democrats and Republicans actually came together in Washington and created a very significant stimulus bill that helped those that were unemployed, small businesses, and actually sent stimulus checks to many Americans. And I think that really got us through that difficult period until summer when some businesses began to reopen. The other thing that was obviously prevalent and is still in our minds today was 2020 was a presidential election year. And those years tend to be more volatile anyways. And we saw extreme volatility, really unrelated even to the presidential election this year. But we did expect more volatility, but boy, were we sidetracked when we were hit with this COVID. And again, kind of going back to what I mentioned, some key takeaways from 2020 is the unprecedented drop in the equity markets really wasn't the case. I mean, that's to be expected if you're an equity investor. Again, it was the sixth drop of 30% or more since World War II, just in US markets. And my second takeaway from 2020 is you cannot make an investment policy based upon who the president is. In my 30 plus years of doing this, every time I've sat down with a family that wanted to change their allocations because of who the new president was, it has ended up hurting them every time. The history of the US is the economy grows over time and equity markets grow over time. And we have to remember that. It doesn't matter who the captain of the ship is. So as we look back at last, kind of reflect on the investment world, last year we had the COVID winners. Who were the COVID winners? They were the Amazons, the Apples, the Google, Microsoft, and Facebook. These companies, these 5 companies alone, were up on average 66% last year. While the average company in the S&P 500, so the other 495 companies, were up on average 3% versus the 66% of these big 5. It's so crazy because over a third of the companies in the S&P 500 were still down over 20%, while these other companies, the big 5, were up 66%. So we've never seen quite that disparity in the equity markets, or we have, but it's been over 20 years since we saw that. It would have been late 1990s, back in the 60s and early 70s. So a huge disparity between returns in the equity markets. But that began to change in September. We saw a real broadening out of equity returns and which companies were doing well. Actually, we saw international, emerging economies, and smaller companies have a significant fourth quarter. Internationally emerging were up over 20. Small US companies were actually up over 30% just in the fourth quarter alone. And again, that reinforces the fact why we stay diversified with our investments, because we just don't know what's going to do best. When human nature would tell us to pile into these large cap technology stocks, it's actually the time that we should have been reducing our exposure to them. So again, lessons that we can learn during a very difficult year for all of us, both from an investment standpoint and just from the standpoint of the country and health and all of that. So where are we now? Well, one of the things that's happened with the shutdown in the economy is savings have increased. People weren't able to spend as much money. So we had this huge influx of savings. Cash levels at banks, money markets, whatnot, are at record highs. Hold on just a second. I'm gonna have the heater on here today, so it's actually quite warm in the office now. But we have cash at all-time highs. US household net worths are at record highs. And the reason I'm mentioning all of this is because this will lead up to the pent-up demand that I'm going to talk about here in just a minute. Retail sales, in spite of the shutdown, were actually up year over year through November. They began to taper off a little bit at the end of the year, but we've got a new round of stimulus that's coming out. So I would expect that to remain strong as we go into this recovery period. Mortgage applications at record highs, people refinancing, home sales at levels we haven't seen since 2008, sort of the end of the housing bubble. And these are all very important statistics because people refinancing their mortgage, what that does is it frees up cash flow, gives people more money to spend. People buying new homes, that's a great leading economic indicator because they buy new furniture, they buy a new car, they buy new appliances. There's all these new expenditures that go along with people buying new homes. What's been really interesting to see during this downturn was what people did, buying new homes, renovating their home, getting pets, exercise equipment. The gym shut, so you buy exercise equipment. But indoor, outdoor renovations, furniture, there were times where you couldn't get your hands on furniture. Online shopping. I think things that are going to be with us going forward are going to be curbside pickup, food delivery. Everybody's going to deliver food now. Restaurants have found once they're able to fully reopen and keep their restaurants full, I think this delivery is going to be something that we will continue to see going forward because it's a whole new avenue of business for these restaurants. And what's been great to see is sort of that American spirit, that entrepreneurial spirit, as people have gotten incredibly creative with their businesses through this time period. And that will roll over into this recovery, to this economic expansion that I would fully expect to see as we get into the second half of next year. Now, one of the tough points has been unemployment. We've gained back over half the jobs that were lost during the recession, which, by the way, speaking of recession, we may still be in recession. The economy has not grown back to where it was in February. The National Bureau of Economic Research, who states when we're in recession, when we come out, has not really reported if we're out of this recession or not, but it still feels like a recession. And a lot of it is because of how many people are unemployed. And I think this is going to take a while because we've got to get service businesses reopened. We've got to get travel businesses reopened. And that's going to roll into the second half of this year and into 2022 before that really happens. So it's going to be recovery. I think we could have a robust recovery in the second half of this year and into next year, but it's still going to take a little bit of time. And that's the thing, is we have to remember, we've got to be patient with this, and we will get these people back to work. Other exciting things is there were well over 1 million new company starts last year. Some of the greatest businesses in the United States today were started during other periods of a difficult time. And I think we will see that here going forward. New technologies. Here we are talking, you know, these virtual conferences. I think this is going to increase productivity as we go forward. And there are a number of people talking about, we have had sort of this stagnant, slow productivity growth in our economy for the last couple of decades. And this might be something that actually really spurs us on going forward. So we'll see. But not just with technology, but also medical technology. Right now, there's a lot of complaints in the media about vaccines not rolling out fast enough. But think back to March of last year. They said it would be the end of 21 or into 22 before we had a vaccine that we could distribute. Here we had one that was out before the end of 2020, and it will get to us. And I think as we get out of the next few weeks, the next month or two, we're going to see drastic changes in these COVID numbers. Hopefully it'll impact the people that are dying the most as we vaccinate people over 70 and those with more vulnerable conditions. So let's hope that's the case. But coming back to medical technologies, I have a good friend that does medical research, cancer research in the medical center here in Houston. And we're seeing the same type of things with cancer research. And what we saw with this vaccine, which by the way, was 2 cancer researchers in Germany that developed the Pfizer vaccine, and they had it developed in March. It was because of all the FDA approvals that they had to go through that we weren't able to distribute it here until November. And that's going to be a point of discussion, I guess, as we go forward, as these things creep up, is do we begin to vaccinate people earlier before we go through all this testing? I know a lot of people have all kinds of crazy theories about this, but if we're going to be losing thousands of people, why not start vaccinating people earlier? So anyways, we will see, I think, continuously medical innovations, technological innovations that will be with us going forward. And I think we'll have a huge impact on our economy as we go forward and productivity. Now, we have a new presidential administration, and I think based upon, they haven't come out with a lot of information, but during the election cycle, there was talks about probably changes in taxes. And we will watch that closely based upon what was said during the election period. It probably will impact businesses mostly and higher income people, but we'll keep a close eye on that. The other thing is your state and local tax deduction that has been capped at $10,000 a year. If you live in a state that has state income taxes, this is probably going away, so you'll probably be able to deduct that along with all your property taxes and your state sales taxes. So that's probably a change that I would expect to see. It was actually tagged on to this last stimulus bill here in December, so I think that will come probably in the first big bill that comes through. So I would expect to see that along with more stimulus, because that's been promised here just in the last couple of weeks. So real quick, I do want to end with, as I've been speaking with people here in the first couple of weeks of the year, I still sense just real stress and anxiety within people. And of course, we had the riots that we had last week. We had riots all last summer, last spring. And I think a lot of this is attributable to just the COVID and just the shutdown of so much stuff. But I want to reinforce that we will get through this. We will get through this time period. And I think literally we are just a few weeks away from having many people vaccinated, and we can begin to do things again. So I know I'm a financial person, but I feel too that as I talk to people, I just, sharing that compassion, and for all of you too, is reaching out to those that you care about, connections you have, and maybe people that are still living on their own, because people are really down. So let's do what we can just to help other people. And here we are in the dead of winter with short days. It's dark at night. So let's just keep that in mind. And I'm going to finish just on kind of my 4 thoughts as we go into 2021. And one is I do expect elevated volatility. We're not out of this recession yet, I don't think. Markets are really priced for a smooth recovery. So I would expect elevated volatility. The dollar weakened a bunch last year, quite significantly, actually over 10% against other currencies. I expect to see probably continued weak dollar. I don't know if it will continue to weaken more, but probably continued weak dollar, which ultimately is good for the United States with trade. It makes foreign goods more expensive, but it makes US manufactured goods less expensive around the world. So ultimately, it could be a positive for the US. Again, I mentioned the pent-up demand. I do expect to see the second half of this year be more robust than the first half of this year. So again, if we can make it through into spring and early summer, I think we will definitely start seeing things getting better. And from our perspective, and a number of the partner firms that we work with, international valuations look actually less expensive than the US. And I think that could be a trend that we see here maybe for a period of time as international companies recovering, and they'll do better than the US, but doing better. So again, we will stay broadly diversified as we always do, with exposure to international, these smaller US companies, like we always do. So that's all the prepared remarks I have. I'm gonna ask Bree, if we didn't have any questions emailed in, I'm gonna see if any of you have questions. You can pose a question. You can raise your hand or just type one in. Bree, are there any questions before we end the call?
I'm not seeing any questions.
Okay, if there are no questions, what we'll do is we'll end the call. If something comes up and you'd like to talk further on this, reach out to me via email. I'll be happy to jump on a call with you and give you any perspectives I have. But thank you so much for being on the call today and participating. And we look forward to seeing each and every one of you in person this year. Have a great day.